Welcome to the NREM podcast, where we discuss the law for real estate investors. Andy and Sean are both attorneys. Nothing said in this discussion should be considered legal advice. We're simply providing information and education. You should consult with an attorney in your state regarding any specific legal issue that you may have. Hey, good morning, everybody. Welcome to the show. Today, our topic is, will an economic crisis create opportunities or challenges? I'm Andy Fowler, and I'm here with Sean St. Clair. Guys, today is my birthday, and the one thing that you can do for me on my birthday, the one thing I want more than anything else in this world, is for you to go to YouTube and for you to click the subscribe button and for you to like our Facebook channel. That's all that I ask. That's not a lot. But if you want to give me the present I so desire, that is what you can do. With that, Sean, give us our legal update for today.
All right. Thanks, Andy. Happy birthday.
Thank you.
Awesome. All right. So our legal update for today is utilizing trust ownership to buy and sell real estate. In Arizona, we have a statute, and there's a few other states that have this statute as well, or a similar statute, which basically states that when you convey property to or from a trust, you have to disclose the beneficiaries of that trust. And so a lot of people say, well, I want to do a land trust in Arizona, and I want anonymity. So I want to own the real estate in the name of a trust that has kind of an anonymous name. And I don't want anyone to know that I'm behind the trust. Once again, we've had this discussion before. Anonymity is not asset protection. It's, more of just kind of a privacy type thing, deterrent type feature.
Sure.
But in Arizona, our statute says that if you transfer property into the name of a trust, or you transfer property out of the trust, you have to disclose the names and addresses of the beneficiaries of the trust. Well, by anonymity, right?
Right.
So how can you still utilize a trust to own real estate while keeping the anonymity and while giving you the ability to basically convey that real estate by essentially changing the terms of the trust? Well, one way to do that here in Arizona is to make the beneficiary of the trust a LLC that has anonymity, like a Wyoming LLC or Delaware LLC, or better yet, have it be an Arizona LLC, which is then owned by a Wyoming or Delaware LLC. In that case, then you can make the trust anonymous, if you will. And so when you buy or sell the real estate, the beneficiary of the trust is going to be this anonymous LLC or whatnot that you ultimately control. No one just knows that you control it, right? Well, then you can, if the real estate's held in the trust, you could, as the grantor or creator of the trust, because the trust document is not a public record, right?
Right.
You could then amend the trust to name other individuals or other entities as being the trustees and beneficiaries of the trust, and give them the full authority to control and amend and modify the trust going forward, so that in essence, the title to the property never transfers. It's just the trust ownership changes. Obviously, you would want to pull in a CPA, tax attorney, to just make sure that everything is going to be okay doing a process like that from a tax standpoint. But you can utilize trusts in Arizona to buy or sell real estate, and you can keep that anonymity. It just takes an extra step or two to do it here in Arizona, as opposed to maybe other states where you don't have to disclose the names and addresses of the beneficiaries when property is obtained or title is put in the name of the trust and then transferred out of the trust.
Yeah, and it's an important consideration to think through, because the answer is to, if you want anonymity, the answer is not to just avoid the disclosure requirement, right? There's a consequence to that, right?
Yeah,
If
an
somebody
invalid
fails,
deed.
right?
Yeah,
So you fail to disclose just because you want to keep anonymity, you've screwed up the entire process.
correct. Yes. Yeah, so you can utilize a trust in Arizona to hold title to real estate, similar to a quote unquote land trust, except you have an extra step or two to do it and accomplish the same objective.
Very interesting. All right, thank you for the legal update. Let's talk a little bit about NREM news. We've been talking about this for the last few weeks, but today is the day. This afternoon is the afternoon. NREM will be live on site and live streaming from the buy and hold meetup tonight, starting at 4:00 p.m. The location is going to be the Scottsdale Area Association of Realtors in Scottsdale. So what that means for you, the listener, you will have the option certainly to watch us live as we do the event. Uh, uh, but we also encourage you to come and be there with us. We'll be interviewing real estate investors while we're there. If you'd like to come down, be on the show, we'd love to have you down there as well. So think about coming in person as well. Sean, why don't you give us an idea about when we're talking about who can come, who this meet and buy and hold meetup is really for, who usually comes?
So this meetup is for real estate investors or individuals and businesses involved in real estate. So you don't have to be an investor. So, for example, our law firm, you and I have attended the event in the past. I regularly attend. There's other attorneys that work with real estate investors that attend. There's title companies that attend. There's lenders that attend. There's property managers that attend, and so it's as well as a number of a large contingent of real estate investors that attend. And so it's basically anybody that's involved in real estate who it's designed for. But essentially anybody can attend the event. And
Now you're going to be speaking, correct?
I will be speaking at this event, and
What
my topic will be
What are you going to be speaking about?
my topic will be the legal issues involving creative finance. So we're going to be going through the different types of property that is a good fit for creative finance. We're going to be going through the different structures for creative finance transactions, as well as the provisions that, not only provisions, but the documents that you're going to want or need to um, move forward and consummate a creative finance transaction, as well as the clauses you're going to want in those documents for a creative finance transaction. So yeah, I'm going to be speaking, and yeah, it'll be a great event.
Tell our listener a little bit about what we're going to be doing from the podcast side of things while we're there.
So we're going to be basically live from 4 to 5 doing different interviews. So basically the event is from 4 to 6:30, 7:00. And the first hour and 15 minutes, so from 4 to 5:15, it's open networking. And so there's people there, chatting, collaborating on transactions. And it's just a good opportunity to meet other investors and those that are involved in the real estate community. So you and I, though, will be live during that time. We're going to be interviewing the hosts of the event. We're going to be interviewing some real estate investors, and then there will be opportunities for anyone at the event to, if they have a legal question that they think we can give some guidance on or answer. Obviously, we're not giving specific legal advice, but more of a general question on, hey, if I'm doing this type of transaction, what documents do you think I should be utilizing? That type of thing. We can give some guidance on that and give some legal information and education. And so we're going to be answering those questions there at the event as well. And then we'll take a short break. We'll set up, and then my presentation will be actually live streamed as well.
All right. So if you're thinking about coming down, again, it is the buy and hold meetup starting tonight at 4:00 p.m. The Scottsdale Area Association of Realtors. Hope to see you there. It should be a good time. We're really looking forward to it. All right, with that, we're going to shift to our topic today. And our topic again is, will an economic crisis create opportunities or challenges? And I think what we thought was important about this topic is not that we're suggesting that we're in an economic crisis, uh, but we are no doubt in a stage of the market where there is economic slowing, as we can, regardless of what asset class you're talking about. There's economic slowing as it compares to last year, and specifically, of course, we're talking about real estate. Why we thought this was an important topic is both Sean and I uh, practice as attorneys together in a previous economic crisis. We've actually seen it and been there from the lawyer side of things on what economic crises actually look like. And for those that are new to the real estate game, or not even new, right? If you just entered the real estate game in what, the last 10 years, you don't know what an economic crisis looks like in really any stage of the game. So what we thought would be helpful would be a discussion about, what that kind of looks like, what kind of opportunities and challenges that you can stand to consider and be prepared for. Last week we talked about, diversification and this idea that some investment strategies are great for certain types of markets, and some investment strategies are great for other types of market, and being prepared for those shifts. But we wanted to kind of give you an idea about what that looks like, what the conditions start to look like. And what we've seen so far, obviously, is rising interest rates and a really an intentional slowing from the Fed of the economy. And we're seeing kind of some expected consequences of that. But what could that look like? And we wanted to talk, first of all, about some potential crisis or potential events that we could start to see, and that we saw in during the last kind of what we called the Great Recession. And the first one that comes to mind, the banks could just stop lending, right? As you enter into uh, uh, a credit crunch or a financial crunch, banks just stop lending. And we saw this doing construction litigation and real estate work before. Big development projects right in the middle of development had to stop because there was no more money either that they could draw on the construction loans, um, or as long as that goes. What are your thoughts, Sean, in terms of what you recall seeing and how that process could play out with banks and just the ceasing of lending?
Yeah, it was a major problem, both on residential and commercial. So at that time, back in 2008, I represented a lot of contractors and even some developers, and they were in the middle of their projects. And frankly, everything was going well. They were on time, on budget. They were ready to go, and the banks freaked out and they said, "Nope, we're not paying any more money." And what made it even worse was that, and this did catch up to some of the banks, and they ended up having some liability over it. But what made it even worse was they froze the funding without ever really informing anybody that they were doing it, without giving any advance notice. And so you had contractors, subcontractors, material suppliers who were banking on being paid for their work, and they're out there working for 30 days while the bank is sitting there knowing that they're not going to pay any more money out, and they're not notifying anybody of it. And for some of the smaller subcontractors, contractors, even some of the smaller material suppliers, a loss on a commercial job is a big hit. I mean, the margins are pretty small. And so, a lot of times, they're out of pocket, maybe even a subcontractor who's buying supplies for the project. Um, and those materials get delivered, and, the supplier has no use for them anymore, doesn't want to restock them. So they don't come out and pick them up. They're not used in the project. And all of a sudden, the person on the hook is a subcontractor. So they're out of pocket that money. they're out of pocket for labor and other costs. And all of a sudden the bank's like, hey, we're not going to lend any more money. Thanks for your 30 days of work on this project, but we're pulling the plug. And unfortunately, down goes the project. The developer files for bankruptcy, maybe the contractor files for bankruptcy, maybe some of the subs file for bankruptcy, but it's gone and everybody loses money. And then there's a dispute as to who has priority on the project for liens and that type of thing. And sometimes the contractors, material suppliers, they were able to establish a break in priority and that they were ahead of the lender. Other times, no, they weren't, and they were just out. And so it was a real bad situation. The other thing that we saw is on residential, and I had this happen to me, and it was a financial burden. I had an equity line of credit on a rental property, and I had paid down that line of credit pretty low. Thinking that, hey, I'm going to put a lot of money into this line of credit, knowing that, hey, if something happens, I have, one of my kids needs to go to the emergency room and I got a big deductible to pay or something like that. I can just write the check out of the line of credit. The property had plenty of equity. Everything was fine. My income was fine. But because of the crisis, I received a letter from my lender saying, hey, we're shutting down your line of credit. So I called the lender and said, wait a minute, there's plenty of equity here. My income's still good. Why are you closing my line of credit and not advancing any more funds? We just don't like what the market's doing. And so we're shutting it down.
Because we can.
Yeah. And, so we had to sell that rental property, basically get our equity out because I wanted to make sure to have that buffer, in savings to make sure that if there was a catastrophe that happens, that we would be covered. So, instead of being able to hold that rental and let the market, come back, and it was a cash flowing rental, it was a good property. I chose to sell it, and because of what the bank did. I mean, that's what they did. And of course, that bank got a bailout, of course, right?
Yeah, exactly.
They were irresponsible. I was responsible. I took the hit. They got a bunch of money from the government. That's awesome. But nevertheless, so we saw that. We saw lines of credit frozen. And I wasn't alone. That was happening all over.
Sure.
If there was an equity line, a HELOC, a home equity line of credit, man, banks were shutting that down left and right. I mean, there was no question about that.
Well, and I think one of the similarities to the time just before the last financial crisis and to kind of where we are leading up to where we're at now is on the residential side of things, the home equity line of credit was kind of the consumer's savings account, right? That was what they were used to tapping when they needed it, whether it was for something they thought would be nice and they had the equity to get, or whether it was just to maybe go pay bills or pay down credit cards. There was we had this thing called equity and relatively low interest rates and the ability to tap that. And whether that's a good individual financial strategy or not, that was basically the consumer's way of dealing with things. And that got turned off overnight. And when that happens, that just exacerbates the problem, right?
Yeah, exactly. Because then the consumer doesn't have or feels less comfortable spending money, right? I mean, they don't have that fallback. And so they start conserving money and they're not putting money into the economy. And then you have, all kinds of businesses that are affected, entertainment, type businesses, movie theaters, stadiums, you name it, restaurants. All of those are affected because the consumer and the homeowners feeling uncomfortable going out there and spending. And then it's a whole spiral, right? And that's the other thing. And the reason why they shut off the line of credit, because values were going down. They continued to drop. And so back in the recession, I think the bottom, it took like 3 years to get to the bottom. And then it finally started going back up. But, as you're on your way down to the bottom, another thing that that we saw was that the traditional wholesaling will become difficult, because you have no appreciation, it's depreciation. Uh, who knows whether we're going to have a lot of short sales, but short sales, there is a way to do some some wholesaling on short sales, assuming depending on the lender requirements and affidavits and things like that. But wholesaling becomes difficult. Uh, Fix and flips become difficult because you have a depreciating market. But then there obviously is going to be opportunities. So let's talk about those. Opportunities that come with that. One of the opportunities that I know, and we saw it during the downturn, was the ability to buy properties at trustee sales. So these are sales that are outside of the court system, where a private trustee in Arizona, you can have an attorney, a real estate broker, or a title company service trustee, and they basically sell the property on the courthouse steps after the proper notice and due diligence. And I know, Andy, for our firm, you are the one that primarily acts as trustee for trustee sales. And so why don't you just kind of take us through the process of a trustee sale, what that looks like, and what the opportunities are there with buying property at trustee sales?
Yeah, so a trustee sale, like Sean said, is this out of court private process. It allows for lenders to foreclose their interest that they have through a deed of trust on real property, and to sell the property to recoup what they're owed on their loan. That's basically what that process is. It's entirely non-judicial, so it's done privately, and it's done in the form of or ends in basically an auction, and it can provide the real estate investor some real opportunities, because the legal consequence of a foreclosure or a non-judicial foreclosure, a trustee sale in this case, is that when it's done, any prior liens, junior liens to the foreclosing lien, are wiped off title to the property. So you, as an investor who buy that property, um, can buy it free and clear of any junior liens. Now, it's important, if you're going to take advantage of that opportunity, to be prepared for the process and what that looks like. So there's a lot of different ways to find out um, what trustee sales are happening, when they're happening, but it's gonna require due diligence on you, the investor's part. But the process is basically this: from the point that the trustee notices a trustee sale, which is a recorded document, notice of trustee sale, it's putting the public on notice, the world on notice that a trustee is happening. They give notice 90 days in advance. The statute requires they give that 90 days in advance. So that is a matter of public record. Typically, trustees will work with some sort of, whether it's their own or some other um, office support. Oftentimes, will publish these trustee sale dates online, just to prepare the public for when these are going to happen. But of course, it is a matter of public record, and to know when that, as the trustee sale moves forward and gets closer to the day of sale, which can happen in a variety of different places. The day of sale, Sean mentioned, can happen on the on the or the courtroom steps. It could happen in the trustees' conference room if they wanted to, but they will appoint and direct and give notice of where that's going to be. But there's a process. The investor will bring a check for the trustee of $10,000. And then there's a bidding process. But just jumping back, a week or so, or maybe a couple weeks before the trustee sale, the trustee and the lender together will be working on basically what's called the opening credit bid, the initial price, the opening price of what that property is going to be listed for. And that's the price that's going to give you, the investor, your starting point. But that's not really the end for you as the investor. It's really going to require more due diligence on your part to know um, what lien is foreclosing. It might not be the first lien. It might be a second lien. It could be a third lien. Um, um, that's not the trustee's job to tell you that. They're giving you notice of the lien, and you may need to. You really should do due diligence as to where that is and whether the price that you may be getting it at, whether it's the opening bid, and um, whether that price or some price afterward is going to meet or fall within kind of a price category that you think is valuable. I know that we've worked with a lot of clients, Sean, and we even had a show about this where they didn't do the due diligence. What do you think is the most common mistake people have faced in not doing appropriate due diligence on a trustee sale?
Well, there's what you can control and what you can't control in
Sure.
as far as due diligence goes. So, I mean, back in the day, um, I've known or had clients who've purchased properties at trustee sales where the prior owners like destroyed the property on the way out. Nobody knew about it, right? They poured cement down the drains and the toilets and stuff like that, and they weren't usable and had to whole house had to be replumbed and took all the ceiling fans and kitchen cabinets and countertops and, islands and the whole thing, just cleared out the whole house. And so it was like a shell when they bought it. But that's something you can't really control. You're technically not supposed to step foot on that property to do an inspection unless the owner allows for it. So you're not supposed to even be like peeking in the windows and things like that. I mean, that's a trespass.
Right.
And so, unless the owner gives you permission, you're not going inside the house. You're limited on what you can do as far as a physical inspection. But here's what you can control and the mistakes that we see from a due diligence perspective that you can control. And it mainly involves lien priority. So not fully understanding or appreciating what position that lien is in. So, if a lender's selling a second position lien, there's a couple of things to understand on that. So the first is that you're going to take the property subject to another loan, and you're either going to have to keep that loan current by making the monthly payments, and assuming that the borrower is not paying the second position loan, they're probably not also paying the first position loan. So it's probably in default by quite a few months. And so you're going to have to come out of pocket unless you turn around and sell it really, quickly and flip it. If you're going to do a long-term hold on it, you're going to have to come out of pocket and you're going to have to satisfy the first position lender. But what's nice about this is uh, buying a property a second position via a second position lien is actually not a bad strategy, considering that rates are going up and they've been so low for the last, 10 years. And so the rate that you could purchase the property now, or the hard money, loan that you would have to obtain to purchase the property outright, well, you may not have to do that if you can just make the monthly payments on the first, which may have an interest rate, of in the twos, threes, or fours, right? I mean, that's pretty good. The downside is that there's probably a pretty big chunk of change that you need to come forward with to reinstate the loan and bring it current, and then you just make the monthly payments after that. But not understanding that and not being aware of that, not keeping track of that, not knowing that maybe there's another pending sale, because if you come on record and then 2 weeks later, the first is scheduled to sell, well, at that point, the first doesn't have to give you notice. They sent notice to all the required parties. You take the property knowing that there's a pending sale, and your interest is going to be wiped out if that first goes to foreclosure. So you need to know about the first. You need to know what the status is. You need to make sure that there's no sale pending. And then the other thing, if you buy anything besides a first position deed of trust, is at a trustee sale, HOA is going to have priority. So you need to know, well, how much are the assessments owed to the HOA? How long has this owner the prior owner not been paying their assessments to the HOA? And, are the assessments, is it $50 a month or $300 a month? And of course, what collection efforts has the HOA done? Has it started its own lawsuit and foreclosure proceeding? All of that's going to matter because that's going to dictate the amount that you're going to have to come out of pocket to satisfy and bring the HOA current. So those are things that you have to be aware of. And then there's other things that are out there that can kind of trip you up. One would be one thing that can trip you up is, just like a general encumbrance or a cloud on title that you're not aware of that you have to then deal with. Or bankruptcy is another one that can trip you up. I've had scenarios where property's been purchased, and like an hour before the sale, the borrower files for bankruptcy. Nobody's aware of it. Property's purchased, and the buyer pays their money to the trustee. They get in there and they're hot to trot, right? I mean, they're remodeling this thing, they're demoing, they before you know it, they've spent 30 grand trying to do improvements to this property because they think they own it, only to have the trustee call them up and say, "Hey, that sale, we're undoing it all. We're canceling our trustee's deed. We're giving you your money back." And borrower filed for bankruptcy, an hour before the sale, never gave us notice, and here you go. And you're like, "Well, I'm out 30 grand." Well, too bad, you know. And that's a major mess. That's a major problem. So bankruptcy is another one that you have to watch out for. So what you say, well, how do you protect yourself from bankruptcy if the borrower filed for bankruptcy an hour before the sale? Well, and you've kind of described the process, right? You show up and you give the trustee your 10 grand. Well, you have up to 3 days to deliver the remaining amount. So you could the next day go online, establish what's called a PACER account, which gives you access to all of our federal courts, including bankruptcy. And you simply create a PACER account and run a search by the borrower's name and see if a bankruptcy's been filed.
Sure.
As simple as that. So,
Yeah.
those are the things that can really trip people up with buying properties at trustee sales.
One of the things I've noticed kind of consistently in doing trustee sales as well in what I think could help real estate investors in this due diligence process is understanding what a trustee can do and what they cannot do, who they are, and why they're there. And I get a lot of calls on trustee sales, and I'm the appointed trustee, and the call will be, "Hey, can you get us into the property? Or can you tell us about the property?" As if I'm like a seller's real estate agent. And that's not what I am. Uh, I'm there foreclosing the property for a lender who also is not the owner of the property at that given time. They may become the owner of the property. That's a possibility after the conveyance of a trustee's deed at the end of a foreclosure. But I've not seen the inside of this property other than the legal description and the address and what's owed on the property and things that are a matter of public record. I don't know anything else. I can't tell you whether it's a good investment. I'm not gonna be able to get you a sweet hookup into that thing. So rather than spend your time with the trustee, and that's not to say you shouldn't contact the trustee. The trustee is gonna give you valuable information. They're gonna tell you the credit bid, probably the most important thing, right? That's gonna dictate one of the big factors that's gonna dictate whether this makes financial sense for your investment. Uh, if you have some other interest in the property, like you're the owner, there are some reinstatement rights that attach that I, as the trustee, as a matter of statutory obligation, if those figures are requested by certain people, that I have to give. And so it's not to say that the trustee shouldn't be contacted, but they're not your access to the property. They're also not the person you need to call to try to get a quick sale. It's not up to me whether this property sells or doesn't sell prior to the trustee sale. If the owner of the property, let's say, gets out of nowhere some great offer and it's enough to cover all the liens that are owed on the property, and the lenders have to accept that. That's what's owed to them, and they're not gonna stop that process. You don't need to try to facilitate that with the trustee. Now, you certainly could try to get a lender to maybe to continue the trustee sale, but you're better off really going to the source, the owner, to try to work those deals out.
Yeah, that's exactly right. I mean, the idea of going to the trustee and having some, in around run around the owner is not happening. One of the things uh, that trustees may release with a fee, depending on their relationship with the title company, or they may refer you to whatever title company provided it, is that the trustee could provide or assist with receiving a copy of the trustee sale guarantee. Right? That's like
Sure,
a title commitment.
sure.
And that'll then state it's, can't be relied upon, because it's an abstract at that point of title, or a third party can't rely upon it, but it basically will state, what position the loan is in, whether or not there's other clouds out there, who else is claiming an interest in the property, if there's a first position, or superior lien out there, it'll disclose that. And so that is some helpful information. But you're right, you definitely want to go through the owner if you want access to the property, and the owner doesn't have to give you access. They can say no, and frankly, a lot of times owners that are going through trustee sales, they don't want to give access because this is their house. And one of the reasons why they're sticking with it versus, say, selling it with equity, at least right now, most properties are going to have equity, is because this is their house and they value that house, and they see it as their home. They don't want to lose it. So they don't want somebody coming in and looking at their property, that type of thing. Because otherwise, if they wanted to do that, they would have just listed it for selling and received their equity out of the property.
Yeah, that's right. Now, what some of you real estate investors will know, a couple weeks ago when we had Andrew Bang on the episode, he talked about the ideal property being a distressed property. A distressed property does not necessarily mean one that's in foreclosure, but it could mean, and usually does mean, that the owner's in distress somehow. And they talked about, approaching those folks, looking to find ways to make a transaction work and everything. It is true that owners that are in foreclosure, they're on difficult financial times, but that's not always the case. I mean, if we're talking about a financial crisis again, jumping back a few years ago, how many clients did you meet with, Sean, that were not maybe in financial distress, but had made basically an economic decision? And we'll get into the anti-deficiency statute later, but because of Arizona's law, they basically were making a credit and an economic decision that they were gonna walk on something they could have otherwise afforded.
Yeah, we saw a lot of that. So obviously there were some people that had a loss of income, loss of job, um, overextended themselves, and could not afford the house. But there were other individuals that and clients that came to me for advice on our anti-deficiency statutes, who basically said, "Hey, look, I bought it for this price. It's worth this. I don't see it coming back anytime soon, and I'm just ready to move on." And or maybe they could afford it, but life circumstances have changed, right? They had a big house because they had kids, and now they're empty nesters and they need to downsize, but they can't sell it for what it's worth. But you know, they're looking at the prices of the homes that would be downsize homes, and they're like, well, we could afford those, and they're really good deals right now. So what are our options? And I obviously would meet with them, consult with them, go over our anti-deficiency statutes, and then they have to make a decision. And I could never and would never advise anybody to stop paying their mortgage, that type of thing. I mean, that's not for me to advise. All I can do is say, here are the ramifications of what happens if you don't pay your mortgage, and then they, make an informed and educated decision at that point. But yeah, that's, um, there's some people are in distress in the sense that their property values have gone down, but other people are in distress themselves financially because they can't afford to pay their mortgage every month.
Yeah, and I bring up that only to basically say for the real estate investor that just because the property's in foreclosure does not mean that the owner isn't otherwise open to creative ways of moving this property and getting out from under it. And from a credit perspective, the hit to one's credit to escape out of that without a foreclosure, like via a short sale or something else that can be done, can be preferable. And I think a lot of those potential homeowner or those homeowners would consider, another avenue.
Yeah, I agree wholeheartedly. And this kind of gets into the topic tonight, right? The different ways to purchase property by creative financing. But yeah, you have an owner who is like, hey, I don't want to take care of this property anymore. I want to downsize, but I don't want to destroy or damage my credit. And so, what are my exit strategies? Well, a short sale is going to damage credit. A uh, foreclosure is going to damage credit. A deed in lieu of foreclosure, where you basically deed the property back to the lender instead of going through foreclosure, is going to damage your credit. All of those are going to have damage on your credit. So then, what are the options? Creative finance, allowing somebody to take over the property subject to your existing loans, is one possible exit strategy. And that's where the buyer would agree as part of the transaction to pay your monthly loan payment for you, so that they can utilize the property. Maybe they see the property as still a fairly good rental. And maybe you don't want to deal with being a landlord, right? You're like, I don't want to do that. Or, it's a good Airbnb, which maybe nothing about as a homeowner. And you're like, I don't want to deal with that I don't want to have to worry about listing it and dealing with short-term rentals. Maybe the buyer thinks that with some improvements, even with the market maybe shifting, with some improvements, they could turn around and sell it for a profit. Who knows? I mean, if it's underwater, it's probably underwater, but you never know. But there's options there, and there's a number of ways to structure that subject to transaction. You can use a traditional sales process whereby the property is deeded to the buyer, and then the buyer in turn delivers to the seller a wrap, a note and deed of trust, which basically says, I'm buying it for the terms of your existing loan, and I'm going to make the payments either to a servicer who will then make them to your existing lender, or I'm just going to make them directly to your lender. It's like what we call a mirror wrap, right? It just basically says my loan is going to mirror your current financing, and I'm going to make the payments. And if I don't, then you have a right to come in and take the property back. You have an agreement for sale, whereby, once again, you can mirror it as to the existing financing, and so you make those payments to the lender or to a servicer. And we tonight I'll talk more uh, uh, directly and specifically about the difference between, or the importance of having a servicer versus not having a servicer involved in the transaction. Uh, and then third, you could do a lease with an option to purchase, where the buyer says, okay, I'm going to pay you so much per month as a lease. And then I want the option, though, in 5 years or whenever to purchase the property. And of course, the lease amount that you're receiving as the seller is going to be equal to or greater than your mortgage payment every month. And part of the lease, um, then you can use the funds from the lease to write a check to your lender and pay your mortgage. So, there's a number of creative strategies out there that would allow a distressed seller to exit the property um, without damaging their credit. Now, all of those that I've listed could potentially invoke the due on sale clause. So there's, you'd want to consult with an attorney and find out, what it means and when does a lender invoke the due on sale clause? How is it invoked? What are the options if it is invoked? What does that mean from a credit perspective? That type of thing. But basically, any of those three may give the lender the right. So it's not an immediate breach of the contract, but it basically gives the lender an additional contractual right, which is the right to accelerate the loan because the property's been conveyed or a substantial interest in the property has been conveyed.
Interesting. I wonder, I don't I don't know what this would mean in foreclosures, but this certainly could impact how aggressive a lender might decide to be. And just thinking about that scenario that you just discussed, um, in the past, it was kind of thought, well, the lender's getting their money, and as long as they're getting their money, are we really worried about them invoking the due on sale clause over this? Usually, I mean, the chances have been, well, probably, maybe they won't. But in a rising interest rate environment where loans that were what? Just months ago were in the 3% range and are now approaching 7%. Do you think the lender has incentive to want a new loan at a higher rate?
Yeah, that's an interesting thought.
I'm literally thinking about this
Yeah,
on the fly. Yeah.
well, and that could go either way, right? With the rising interest rates, is the demand for loans going to go down?
Right.
So you don't need as much, and you don't want as much money sitting there, um, you know, waiting to be lent and no ability to provide the funding and receive that higher interest rate. Um, yeah, it really depends. These big servicers that are federally insured, they don't want to take. Yeah, granted, they'll get some insurance from the government, but it's not 100%. And they don't want to take a huge loss normally. And a lot of times, if their loans are current, they aren't even you're not even on the
You're not,
radar,
yeah, I
right?
don't even know.
But a smaller lender who's like, hey, I could get rid of this 3% mortgage on my books and I could turn around and use that same money to earn 7%. They may be more aggressive in invoking the due on sale clause.
Interesting. So we've been talking about trustee sales and opportunities that non-judicial foreclosures present, but in Arizona, we also have judicial foreclosures, also known as, in some cases, the sheriff's sale. So, Sean, give us an idea about the general process of a sheriff's sale and what opportunities exist there.
Uh, so right now we're seeing more sheriff sales than what we would see during a downturn. And the reason is because lenders that are going to sheriff sales or sheriff sales are happening for liens that have to be foreclosed judicially. The most common would be your HOA liens. So your HOA lien is always going to be behind the first position deed of trust. HOA liens have to go through a sheriff's sale, and the process for that is the owner doesn't pay, And so there's unpaid assessments. And then the HOA sends notice and does their whole process to try to collect. They can't collect. And so now the homeowner has a tab with the HOA, and there's um, statutory requirements of when they can foreclose. And I won't get into those, but the account has to be so many months past due, or the balance has to be over a certain amount before they can foreclose. But assuming that they meet that criteria, then they send it out to the attorney, and the attorney files a lawsuit, serves the homeowner, and that lawsuit asks that the sheriff or the judge, the court, enter an order requiring the sheriff to sell that property at a sheriff's sale. So the lawsuit served, the homeowner has a chance to answer. At some point, whether by default or by a motion for summary judgment or by trial, it's likely that a judgment's going to be entered against the homeowner, and that judgment's going to list the amount that the homeowner owns, and then that judgment is going to then basically order the sheriff of the county to sell the property at a sheriff's sale. That's delivered to the sheriff with a writ of special execution, which is the court's way of saying, "Okay, sheriff, sell this property." The sheriff then notices the property up for sale, and then it'll sell the property at the sheriff's sale. However, it doesn't end there. The buyer at the sheriff's sale does not automatically receive title to the property. They receive basically a right to receive title and a notice that's recorded that they were the successful bidder, but you have to wait for the redemption period. And normally the redemption period is 6 months. During that 6 months, the homeowner can come out of the woodwork, or even the homeowner's successor in interest can come out of the woodwork. Junior lien holders can come out of the woodwork and basically redeem, pay the amount of the sale, and buy the property back from the individual that purchased the property. After those 6 months, then finally the sheriff enters a sheriff's deed and conveys title to the property to the buyer. The reason why we will see actually a downturn of sheriff sales during an economic downturn and a scenario where property values are going down will be we'll see that because of the fact that HOAs will look at the property and be like, hey, they don't generally want to own the property. That's not their goal with a sheriff sale. Their goal is to get their money. That's what they want to do. And so they'll, look at the value and say, well, the first position lender is owed 400,000. The property's worth 350. Why are we going to go to a sheriff sale? And so you're going to actually see sheriff sales slow down, but there's still an opportunity because assuming that there are any going on, there's less bidders because potentially the value of the property is, down and has depreciated. And if you're willing to take the property subject to the first position loan, reinstate that loan and make the monthly payments every month, maybe you do want to take it and purchase it at the sheriff's sale.
We have a few minutes left, and I want to talk about short sales. One of the benefits of having gone through a pretty significant real estate crisis 10 plus years ago was the development of the short sale, really. That crisis started out with, holy cow, what are we going to do? And nobody knew what to do. The banks didn't know what to do. Everybody knew what they could do, but what was this going to look like? And really out of that developed the short sale process. And agents got pretty darn good at the short sale process. We were getting a lot of deals were getting done, and it became it went from non-existent to basically commonplace. So during the prior recession, I think everybody learned how to be good at that. And we have a pretty good backdrop and knowledge base on how to be good at that again. But should that be kind of a tactic or a strategy that investors need to look at short sales? I know this involves the anti-deficiency statute. and all of that. Um, but I wanted to go right to this question for you, Sean. And you can talk as generally as you want about short sales, but I'm interested in wholesaling has become such a popular thing in this most recent market. Maybe it's slowing some because of the market now. But how can wholesaling and can it be utilized in the short sale context? Should we kind of get back to that market again?
Yeah. So I just want to say that, what we saw back, in 2008 through say 2012, 2013, um, was short sales created a huge wealth transfer. Um, there were a number of individuals who viewed this as an opportunity to buy property that was really low and undervalued. And so there were people who went out and looked at their retirement accounts and said, "Hey, look, um, I'm going to do self-directed IRAs and I'm going to just start buying rental properties." And there's other people who went and, you know, used a lot of their capital to buy rental properties and bought them at, bargain basement prices, who are ultra wealthy now. At least, they have significant assets because of the appreciation that we've now seen with those properties and with other properties. So it created a huge wealth shift. And I don't know that that's going to be the same now, but those that took advantage of it are, really wealthy now,
Right.
and have tons of assets. So wholesaling in particular, though, so short selling, buying a property at a short sale is great for a long term hold, especially if you think that the property is undervalued, and has gone down so much that a decent rebound, and all of a sudden now you're looking really good from a equity standpoint, not to mention, cash flow. But wholesaling of short sales, can it can it be done? Yes. We're gonna have to see exactly if short sales become a thing again. We're gonna have to see what the bank's requirements are, and what they say as far as, are they going to allow properties to be purchased in the names of trusts? Are they going to allow properties to be purchased in the names of LLCs? Um, or are they going to require that the buyers be individuals? And if they're individuals, that's going to be a lot tougher. And it would be more of a um, more difficult, because most banks, towards the middle to the end of the short sale era, they started putting in their affidavits that the buyer can't transfer or convey the property for 90 days. Um, Now, what does that mean? What does transfer or convey mean? Could you do an agreement for sale? Could you do an option, and buy it, in your personal name, and then offer that to a subsequent buyer immediately upon close of escrow? Sure, you probably could do that. Um, Depending on the language of the affidavit, right? You don't want to sign an affidavit that misleads the bank, because that's, loan fraud. So you have to look at the very specific provisions of the affidavit to say, are they what do they mean by transfer? Is it, fee title transfer? Is it deed transfer? Or is it, providing an interest in the property? So a lot will be dependent upon the language in that affidavit and what you can or can't do, right? So you have to be very careful with what you represent to the bank, and you need to make sure your representations are accurate. So that's number one. But if a bank does allow for property to be purchased via a trust or via an LLC, well, then you could convey an interest in the property via a conveyance of a personal property interest, or via the amendment of a trust, versus actually conveying the real estate by deed. That makes sense. So if the trust is going to buy it, then and the bank approves the trust to buy it, unless the affidavit says you can't change the beneficiary of the trust or the trustee of the trust, you can go and change the beneficiary of the trust and the trustee of the trust, um, at any point, right? And so if if the bank doesn't require that and doesn't have that as a restriction, then you can do that. Same with an LLC. If the bank approves an LLC purchasing the property and doesn't put a restriction in their approval or in the affidavit that the buyer has to sign saying, oh, you can't convey a membership interest, which is personal property, it's not real estate. You can't convey a membership interest in the buyer for however long, or you can't ever convey a membership. You're restricted on that, or prior to closing, you can't convey a membership interest in the LLC. There would be nothing stopping you from, conveying a membership interest in the LLC prior to closing. And, that's how you would effectuate essentially a wholesale of a short sale. But it really is going to depend upon what you have to represent and affirm to the bank and the bank's requirements of approval of the sale. And we'll just have to wait and see. And each transaction may be unique on that. And so that is something, though, that could be doable if it's structured correctly and done correctly. But I think we're a little ways from that right now with the market. And knock on wood, maybe we never get there and don't have to deal with the short sales.
All right. Well, we will have to wait and see. But when there is blood in the streets, that is when the investor has sometimes the biggest opportunities. So we hope this show was helpful to you. Reminder, we will be this afternoon again at the Buy and Hold meetup tonight at 4 p.m. Make sure you're there with us. Love to see you. And if you can't make it, make sure to watch the live stream. We'll see you then. Thanks so much for joining us.
Have a good day, everyone.